All right, let's get right into it. If you've spent any time at all staring at trading charts, you know the drill. You see the classic W patterns, the head and shoulders, all the trend lines we're taught to follow. But today, we're going to put these popular theories to the test. Are they actually winning strategies, or are they just really clever traps designed to take your money? And look, the reason we even have to ask this comes down to one really shocking number. Recent data is showing that something like 99% of retail traders are losing. I mean, that is just a brutal failure rate, and it forces us to ask a pretty uncomfortable question. With a number like that, you've got to wonder, what if the very tools and patterns we're all taught to use are actually part of the problem? Could these textbook plays be the very reason so many people are failing? That's really the core question we're going to dig into. To figure this out, let's put one of the most famous patterns in every retail playbook under the microscope. I'm talking about the W pattern. You know, the one they call a double bottom. It's supposed to be a classic sign that the price is about to go up. So the conventional wisdom, the stuff in all the books, goes something like this. First, you spot that W shape. Step 2, you wait for the price to break above that middle peak, what everyone calls the neckline. And the perfect entry? The books say you should buy when the price comes back down to retest that line, turning the old ceiling into a new floor. You tuck your stop loss right below it and, boom, you're in a confirmed trade. Sounds pretty good, right? Well, here's the trap. How many times does this happen? The price breaks the neckline, it pulls back just enough to suck in all the hopeful buyers, and then it just collapses, wiping out every single one of those stop losses. So what's really going on? Well, the so-called smart money, the big institutions, they weren't buying at the neckline with you. No way. They bought way, way lower, at the very bottom of the W, long before it even looked like a pattern. So by the time you see that confirmed entry and hit buy, they're looking to sell. Your buy order is their exit. So that begs the question, why is the market built this way? And that why brings us to the whole idea behind smart money concepts, or SMC. It explains why these traps even exist in the first place. And it all comes down to one single crucial concept. And that concept is liquidity. Now, for you and me, buying or selling is simple. You click a button, you're in, you're out. But if you're a giant institution and you need to buy $1 billion worth of something, you can't just click a button. There simply aren't enough sellers at that single price to fill your order. It's a huge, huge problem for them. They have to somehow find a massive pool of sellers. So here's a great way to think about it. Liquidity is basically the fuel that the market's engine runs on. Without that fuel, the big players, they can't make their moves. They're stuck. And if the fuel isn't just sitting there waiting for them, well, they have to get creative and make it themselves. And how do they do that? Through what SMC traders call institutional manipulation. They deliberately engineer these obvious textbook patterns. Why? Because they know it encourages us, the retail traders, to put our stop losses in really predictable places, like right below the neckline of that W pattern. Then, when they push the price down and hit all those stops, it triggers a massive flood of automatic sell orders. That flood, that is the liquidity. That's the fuel they needed all along to fill their own giant buy positions. So this is the most important part. If you want to avoid being the fuel, you have to make a fundamental shift in how you see everything. You've got to stop looking at the market with retail eyes and start trying to see it the way the institutions do. And this just lays out the difference perfectly. The retail brain is focused on finding those pretty shapes and patterns. It uses lagging indicators, things like RSI, which really only tell you what's already happened. The core question is always, where is the pattern? The smart money mindset, though, is totally different. Its focus is on one thing, finding liquidity. It's not asking, where is the pattern? It's asking, where is the fuel? This means you have to kind of let go of a lot of those standard indicators. Instead, you learn to spot the footprints that the big money leaves behind on the charts. We're talking about concepts like market structure, which is about what the trend is really doing, or things like order blocks and fair value gaps. These are specific zones on the chart that basically act like giant clues, suggesting where an institution has probably done business. They're not just random patterns, they're evidence of where the real money is hiding. So after laying all this out, we get to the final verdict. When you look at a chart from now on, you've got to decide which side of the game you're actually on. And it all really comes down to this one very powerful idea. If you can't look at a chart and identify where the liquidity, the fuel is, then it's almost a guarantee that you and your stop loss are the liquidity. You are the fuel for somebody else's trade. So what this really suggests is that the foundation of a real successful strategy probably isn't about finding a better indicator or a more perfect pattern. It's about a much deeper understanding of the market's logic, understanding why prices are moving, and more importantly, who is moving them. So I'll just leave you with this question. The next time you see a perfect textbook pattern forming on your chart, are you going to see a high probability opportunity, or are you going to see the bait?